Now, let's start there with that demand. I mean, ETFs have really had a good run in the last 2 years. We've spoken about the rise of ETF inflows, but we did see some backtracking in April, levels that we haven't seen since the start of the pandemic. Was that a significant dent then in the growth of the momentum going forward for ETF inflows?
No, I don't. I wouldn't. We wouldn't see it that way. So I think we've seen very steady growth in the industry. This year, the industry celebrates its 32nd birthday and around $10 trillion under management globally. But the bulk of that growth has really come since the 2008 crisis. So, there the industry was around 1 trillion. So that, going from 1 to 10 has happened as we came out of the, as the markets rose from that crisis.
Yeah. So looking like really ETFs tend to perform quite well in times of crises, right?
Well, I think in times of crisis is usually when one looks at what we could change or what we could do better. It's often a catalyst for change. So, the 2008 crisis was a huge catalyst for ETF growth in Europe in particular. So, investors there had been burnt by banks going under, like Lehman and Bear Stearns, and suddenly counterparty risk became a very real concern for a lot of the institutional investors that were using products like swaps. And so they preferred a listed instrument without counterparty risk like ETFs.
All right, I get your point there that crises are really catalysts for change, and we've actually had quite a lot of change right now. And I mean, there's no shortage of fear in the markets with the risks that do threaten the global economic outlook. So investors are now trying to protect themselves against inflation, or some even take advantage of it, and some are trying to recession-proof their portfolios. So what kind of ETFs should investors be looking at this time for safety?
Well, we have seen globally the flows moving towards your typical safe haven type of products, like the short duration US Treasuries. Massive inflows coming out of Chinese bond ETFs. So, the typical risk-off sort of trades. However, our position at CoreShares is always to keep your eye on your long-term goals and make sure you've got the asset allocation that matches your long-term goals. Because obviously, if you sit in bonds for too long with too much of your portfolio, you risk being eroded by inflation over a long term.
So the key here would be diversification, really.
Well, that's always handy, yes. Yeah. That's always a safe route to take.
All right. So just give us some of then the different ETF strategies that investors can make use of.
So what's so handy about ETFs is really that they're accessible for all types of investors. And so what we see there is because lots of different types of investors are using the products, they're being used in a variety of ways. So you do have, your typical macro strategist who might have a global view and an asset allocation view, and then they're simply using the ETFs as building blocks. So how much do you want in US treasuries? How much do you want in European equities, Japanese equities, etc. So they're very useful and accessible to get those global exposures in place. And then we have, some other types of investors who like to combine them with single stocks. So, for example, you could have a core satellite type of structure where you, for example, for your global equities exposure, you have an ETF in the core, but around that you still try and select some individual stocks that you want to add some weighting and generate some outperformance. So, if you one of these people who likes to follow Tesla and Apple and some of the big names, you could still sort of add that around your strategy in the satellite to have that combination of the pure market tracking, but also some alpha. And then at the same time, we see some investors who even sort of switch that strategy on its head. So they might have at the core of their portfolio might be a portfolio of shares that they've got a long-term view on and they've held them for a long time and they don't want to fiddle around with it. But they've got some short-term views on the market and they want to be able to tilt and adjust the portfolio based on what they're seeing. So, for example, they might feel a little bit more nervous at the moment and want to add some more bonds into their portfolio. So you could put a bond ETF in the satellite of your portfolio there.
All right. Just lastly, quickly, I mean, you spoke about how, people may be moving out of Chinese bonds and going to US treasuries. In terms of equities, just drilling down into equities regionally, looking at at the dynamics that are going on, what are some of the regions that are making you nervous right now in terms of ETF exposure, and some that where you are seeing opportunity?
Yeah, so there isn't really a region that we've seen sort of strong concern coming out from our investors, more so much as sectors. So obviously the technology sector is suffering. We all saw the Nasdaq was down, double figures in April compared to the
bear
S&P
market right now.
500. Absolutely. So I mean, what we are seeing there is our investors are preferring sort of the more consumer staple type of companies, and so some of the steady dividend payers, and so there are indices, for example, that track an S&P Global Dividend Aristocrats methodology, which really focuses on those sort of reliable, steady dividend payers that, you've got all those household names in there, and they tend to perform throughout the cycle.
Yeah, looking at that, maybe it would be a good time to get some exposure there. We have seen recently the S&P 500 trading under 4,000 points. Thank you very much for your time, Michelle. That was Michelle Noth from CoreShares.